You look at your bank account after paying the month's bills. The paycheck arrived only a few days ago. The rent has already been withdrawn. The mortgage payment is scheduled. Insurance renews automatically. Streaming subscriptions continue without asking permission. A grocery trip costs more than it used to. Nothing unusual happened this month. Nothing unexpected appeared. Yet the remaining balance feels smaller than it should. Many people experience this feeling long before they describe themselves as being under financial pressure. Life appears stable. Income continues. Work continues. The routine continues. Yet flexibility quietly becomes more difficult to find. The immediate explanation often seems obvious. Prices increased. Inflation reduced purchasing power. Everything simply became more expensive. Those explanations are not necessarily wrong, but they rarely explain why financial pressure often continues growing even after income rises, or why people earning significantly more than they did 5 years ago sometimes describe themselves as feeling no more financially secure. The hidden cost may not simply be higher expenses. It may be the gradual process of keeping up. Keeping up rarely feels like a decision. It feels like adapting. A larger apartment becomes necessary after having children. A newer car replaces one that has become unreliable. Professional clothing changes after a promotion. A shorter commute justifies higher housing costs. A subscription saves time. A delivery service creates convenience. One adjustment rarely changes financial life dramatically. Together, they begin creating something less visible, a new baseline. The comforting assumption feels entirely reasonable. As income increases, life should become easier. Higher earnings should create more choices, more security, more freedom. Many financial decisions are made with exactly this expectation. People accept promotions, relocate for better careers, upgrade homes, increase retirement contributions, commit to larger monthly payments. None of these decisions are irrational. Most are responsible. Most reflect progress. The contradiction appears only later, because every improvement that solves one problem can quietly create another. A larger home often requires a larger mortgage. A better neighborhood usually comes with higher property taxes. A newer vehicle introduces larger insurance premiums. Greater income frequently supports greater obligations before it creates greater freedom. Financial life begins changing in ways that are difficult to notice while they are happening. The visible outcome is a more comfortable lifestyle. The hidden driver is adaptation. People gradually organize daily life around the assumption that current income will continue. The behavioral reinforcement follows naturally. Monthly obligations become familiar. Automatic payments reduce attention. Recurring expenses begin feeling permanent rather than optional. Convenience removes friction, but it also removes visibility. Eventually, something interesting happens. The income that once represented opportunity begins representing maintenance. Many people recognize this without immediately understanding it. A promotion feels exciting. 6 months later, the larger paycheck already feels normal. The lifestyle has expanded to meet it. The psychological reference point quietly moves forward. The previous standard of living no longer feels realistic, not because it became impossible, because it slowly became unfamiliar. This process appears throughout financial life. A raise creates confidence. Confidence supports larger commitments. Larger commitments require continued income. Continued income becomes increasingly necessary. The cycle rarely announces itself. It simply becomes everyday life. This is why keeping up often feels less like ambition than obligation. The pressure does not always come from wanting more. Sometimes it comes from maintaining what already exists. Many people notice this during ordinary decision moments. An employer offers a higher-paying role. The salary is attractive. The responsibility is greater. The schedule becomes less flexible. The decision appears to increase financial freedom. Yet declining the opportunity begins feeling increasingly difficult because existing expenses already depend on future income. Another decision arrives. Housing prices continue climbing. Waiting feels risky. Buying requires a larger mortgage than originally planned. The purchase solves one uncertainty while creating another. Years of fixed payments quietly redefine future choices. A third decision appears almost unnoticed. Friends upgrade their lifestyles. Co-workers discuss vacations. Children's activities become more expensive. None of these comparisons necessarily create dissatisfaction. They create normalization. The standard gradually changes. People adapt long before they consciously recognize they have adapted. This is where the financial system becomes easier to see. Markets respond to demand. Businesses respond to incentives. Consumers respond to convenience. Individuals respond to the expectations created by the environments around them. No single participant needs to encourage dependence intentionally. Dependence can emerge naturally from repeated adaptation. The system rewards participation. Employers reward reliability. Banks reward long-term borrowing. Subscription businesses reward recurring payments. Consumers reward convenience. Each relationship makes sense on its own. Together, they create an environment where maintaining momentum often becomes easier than changing direction. Many people only recognize this after encountering disruption. A company restructures. Unexpected medical expenses appear. A family member requires support. An economic slowdown affects employment. The financial pressure often feels sudden. Yet the underlying commitments accumulated gradually over many years. The contradiction becomes difficult to ignore. The lifestyle designed to create stability may also reduce flexibility. The career pursued for security may become difficult to leave. The financial decisions that represented success begin requiring continuous maintenance. None of this suggests that earning more is a mistake, or that buying a home is unwise, or that improving quality of life should be avoided. The observation is quieter than that. Every financial improvement carries maintenance alongside opportunity. Every increase in comfort introduces new expectations. Every reduction in uncertainty may exchange one form of pressure for another. Keeping up eventually changes from comparing yourself with other people to comparing yourself with your own previous decisions. Yesterday's improvements become today's obligations. Yesterday's optional expense becomes tomorrow's fixed payment. Yesterday's luxury becomes today's normal. The financial burden is often less about acquiring something than continuing to support it. This explains why financial pressure sometimes feels disconnected from objective progress. People may earn more, save more, invest more, own more, yet still experience less flexibility than they expected. The issue is not always insufficient income. It is the growing number of things that income must continue sustaining. Perhaps this is why financial freedom often feels more difficult to recognize than financial progress. Progress is visible. A larger paycheck, a nicer apartment, a newer vehicle, higher account balances. Freedom is quieter. It appears in choices that remain available. The ability to reduce hours, to change careers, to relocate, to pause, to absorb unexpected events without every decision becoming urgent. Those forms of flexibility rarely attract as much attention as visible financial milestones. Yet they may shape daily life far more deeply. Keeping up is not simply about spending. It is about adaptation. It is about how ordinary improvements slowly become permanent expectations, and how expectations quietly shape behavior long before people realize they are making different decisions because of them. The hidden cost is not necessarily what people buy. It is the future they gradually commit themselves to maintaining. If financial progress quietly becomes financial maintenance, then when does success begin changing the choices people feel able to make? Finance Simplified explores how incentives and pressure shape behavior over time.